What is going on, investors? Back again. Time for Sunday Q&A day on the Investor channel. I'll include links down in the description and the pinned comment, timestamps to all the questions. So if you want to jump around and find the questions that you're interested in, go ahead and do that. I'll also include a little link to the playlist if you want to go back and look at the older episodes of the Q&A day. And then finally, if you have a question, this show is all about for you. If you have a question, leave it down in the comments below. I'll get to it for next week's episode. Let's jump right into it. Michael asks, I just want to say thank you for the videos. How did you get into this field? And would you be able to give some tips for a 20-year-old? Well, Michael, so I started about 21 years ago. So I started longer than you've been on Earth. It was 1997. I think I got my first job. I was still in high school. And I think I was making $5 or $6 an hour. And my dad said, you should invest your money. And during that time, the stock market was actually pretty hot. It was right during the dot-com age. We hadn't quite peaked in the dot-com age. So I invested about $1,000 into a mutual fund and I doubled my money in a year. And I thought I was on track to be Warren Buffett in a few years. Well, unfortunately, the market crashed and I went from about $2,000 in my mutual fund back down to $1,000, but I was totally hooked. Now, I went off to college, and you're probably either there or thinking about getting into college at 20 years old. And I went to college, and typically when you go to college, money is not something that flows very well in college. And so I went to college, but I studied business, I studied finance, I studied accounting, I studied economics. And I really think studying economics is probably one of the best ways you can prepare yourself after you get out of college to be an investor, to get into maybe the investment field if you want to do that as well. I just think economics gives you such a great background. And so I did that for several years. Obviously went through college with that. And then towards the end of my college career, I actually opened up a small business. This was in 2006. And 2006 was really good. 2007 and then halfway 2008 was absolute disaster. The economy just fell apart out here in Northern California, really across the world and in the United States. But particularly where I was at in Northern California, it was very hard hit by the housing crisis, basically. And so I had to close my business. I had not a penny to my name. I was sitting around. I couldn't get a job. I was still studying some classes. I didn't know what I wanted to do. So every single day I would wake up and I started to watch Bloomberg. I couldn't afford TV, but Bloomberg was streaming free on their website. I could afford internet, or I was stealing somebody's Wi-Fi, and I watched Bloomberg every day. And that was in August and September of 2008. And then obviously by October 2008, I believe the Lehman Brothers went bankrupt and the entire market started to collapse. And that really got me interested in the stock market. And I thought, well, this might be my time to really start to jump in. So I started an account that I still have today. I think that the account now has over $40,000 or $50,000 in it, but I started with $20 in that account. And that $20 was a lot of money to me. I certainly couldn't afford a lot of things at the time. Certainly couldn't afford to pay rent or food a lot of the times. So I put $20 in a stock account and I really went to work in terms of that $20. And I just want to emphasize that I started with 20, but it was like $200,000 to me. Okay, it was a fortune. And so I took that $20 very seriously, researched all the companies, was listening to conference calls. I was buying one share at a time, half a share sometimes at a time. But I was listening to the conference calls, reading the balance sheets, really teaching myself how to research companies. And in my opinion, that really set the stage when things started turning around for the general economy. And then also myself personally with the businesses I started after that, I started having extra money that I could start putting into the stock market. Well, then I had a great background. This is what I always tell people. Someone like you, maybe being 20 years old or maybe even older, that's thinking about just getting into the market. A lot of people think, oh, well, I'll learn how to, play the stock market when I have lots of money. And I actually think that's the backwards way to think about it. You actually want to make your mistakes. You want to learn when the money, while it might be $20, $200, $2,000 might be significant to you. I'd rather make a mistake with a $2,000 account than work for 30 years, build up a $200,000, $250,000, $1 million IRA, and then start making a bunch of mistakes at that time, because then you just don't have time on your side to make up for those mistakes. So when you're 20 years old or you're just starting out in the stock market, don't be afraid to make some mistakes. That is how you learn. But also learn a process, learn how to research stocks, learn how to analyze balance sheets, companies, just all that. If you take your time and learn all that, you can create a repeatable system so you can continue to repeat that. There's a lot of people here on YouTube promoting the hottest stocks, the Nikolas, the Plug Powers, the Neos. Some of these companies might end up being great, but I don't necessarily know if just chasing the hot stock is a sustainable way to build wealth over the long term. If you look at the world's richest investors, they invest in great companies that have a track record and continue to do that over a long period of time. And that's what I would recommend. Build up a system to invest in companies, to systematically analyze them, and systematically put your money to work year after year, month after month, and eventually you'll build up to, hopefully a large amount of wealth inside the stock market. Again, being 20 years old, I would have fun. If you're in college, I would have fun. I would take as many classes as you possibly can. I certainly took extra classes in economics, in accounting, in finance. I took classes that I didn't even need to take to graduate. I would continue to look at anything you do as a learning experience. I am still learning this field. I am still learning about stocks. I'm still learning how to analyze them 20 years later. And I think for the rest of my life, it is something I'll be working on as well. So if you're 20 or if you're young, have fun with it. Don't worry about making mistakes. Figure out what your mistakes are. Figure out what is successful for you, and continue to try to replicate that into the future. So hopefully that helped you out, Michael. Thanks for the question. Next question coming in from a lawyer subscriber to the channel. He says, thanks so much. My question for next Sunday's program will be to please analyze Fastly, ticker symbol FSLY. As a network engineer, I have a great understanding of their technology and what they do. I am not very literate about reading their balance sheet and income statement as myself. I am trying to gather more information about their finances as I plan to keep them for the long term. Own about 50 shares. Nice. I will really appreciate your help in advance. So, no, it's great. So, I tell you what, being a network engineer and knowing the business, knowing what companies are coming up, I would say that's probably about 80% of it. Just knowing the industry. Most of the companies that I personally invest in are advertising companies, internet companies. I live, about an hour and a half, no traffic away from Apple, Google, Facebook, all the major companies. So it's no wonder that those tend to be the cornerstones of my portfolio. And I would say the same thing here. If you're a network engineer, you're going to know way more about the insides of these companies. And personally, I think that's more beneficial than knowing the income statements, because like you said, you can come here and ask somebody else to kind of take a look at it. So really quick, Fastly's just become public. They haven't been public for long. It looks like they went public last year around April or May. And so, but meteoric rise just in the last year or so. Now, what I did notice is they had this big decline during their last reported earnings, or they had a press release that they came out with. TikTok obviously was kind of up in the air. It's still kind of up in the air what's going to happen with it. But I think if the current administration that's projected to win, if they happen to end up taking over, I don't necessarily think TikTok will have as much problems as that they might have had with the previous administration. And so that might be past them a little bit, because their shares popped really nicely after TikTok gets kind of a reprieve from the US ban. So I came here. Stocks recently public. That's something that you need to keep in mind when you go through these financials. I'll show you some spots here where if this company had been around for 4, 5, 6 years, it'd be more of a red flag. But because they've just recently gone public, I tend to give them a little bit of a slide on these things. So let's jump into the balance sheet here. This is probably going to look really good because they've just become public. You'd expect for the balance sheet to be nice. And if it isn't, that actually is kind of a red flag. This is going back to December of 19. So this is about 6 or 7 months of them being public right here in 19. And then this is obviously 9 months going through this year. We see cash and cash equivalents up big time. Marketable securities right in range. We've got about $300 million, about $400 million worth of cash. That's solid. You see the total current assets doubled over this period. Most of it flowing to cash. So what you should, when you see this big of a bump in cash, we went from this is like 130 in cash up to 400. Obviously, it's probably not coming from the business operation. At least I wouldn't necessarily anticipate that, because generating that much cash in 9 months is only what the top end companies are doing in this market. So this is some kind of debt raise, or more than likely some kind of fundraise through the shares. When we get through the cash flow statements, we can see exactly what that is. Let's come down here to liabilities really quick. We see here they've got a little bit of long-term debt, not much. It's stayed flat over the last 9 months. We see they've got a current portion here. It went from 4 up to 6. So they've got to pay that off, but they've got tons of cash. We see here total liabilities here went from 63 to 96. They have that in just marketable securities, basically. So nothing from the balance sheet would have me worried about anything this company, at least from a financial standpoint. Now, statement of operations. Let's see what's going on here. We've got the revenue top line here, and then we've got cost of revenue, and we'll get down to kind of our net income, or in this case, probably a loss from operations. You see here, we got 3 months ended here, 9 months ended here. We went from 50 up to 70. That's solid growth in just a year's time in the quarter. We see for a 9 month, we went from 141 up to 208. That's super solid. And so, you want to maybe annualize this revenue out. We can bolt on. Let's just give them credit for another 100 million. We got about $300 million in revenue. That, again, I'm giving them credit for a sensational last quarter. Well, we got an $8.8 billion, $9 billion valuation. So certainly not a light valuation, especially from the revenue standpoint. But this is when you're growing them these fast, the top line that fast, that valuation can get stretched out a little bit. We take a look at gross profit. So this is a pretty high margin business. I would categorize this as most software companies or network companies tend to be pretty high margin, because we spent 30 to make 70. Notice we spent 22 to make 50. So boy, those margins are nice. It looks like they're coming in real hot, no matter what is happening in the environment. And so we see here, we spent 86 to make 208. That's solid. In the previous period, we spent 62 to make 141. So we went from 78 up to 121 million for the 9 months. For the last 3 months, we went from 27 all the way up to 41 million. So that's super solid from an operating side. You'd like to obviously see this continue. If you annualize this out, maybe bolt on another 40-50 million, you'd be about 170 million operating income, again at a $9 billion valuation. It's a little rich, but again, it's a recently IPO company. Looks like they're growing their market share as well. Now, operating expenses coming in really hot. We see here we went from 12 up to 18, 17 up to 22 for sales and marketing. Here's the big one. We went from 10.5 on general administrative. This is general administrative right here. We spent 10.6 million in the previous period. We spent double that, 24 million, a little more than a double over the most recent period. And we see we did a clean double over the last 9 months. We went from 28 up to 56. So now, normally, if this company was in business for 4 or 5 years, this would be a huge red flag. I'd be like, what are they doing? Why are they sinking so much money into this just general administrative expense? But this is a recently IPO'd company. They're growing. They need staff. They need back office. They need, administrators. They need executives. Those types of things. You'd like to see this start flattening out in next year. That's what I would be looking at this company. If you wanted to add shares, you wanted to buy shares, whatever it was, I would look for these costs to flatten out, because look, sales and marketing's kind of flattened out a little bit. Research and development flattened out a little bit. It's not doubling like we did here. So I'd like to see G&A start to flatten out next year, and that would definitely drive some, not necessarily profits, but control these loss from operations. Because take a look, we went from 50 up to 70 on the top line, but we went from 12.8 million loss from operations up to 24. So we really improved our top line. improved our gross profit by quite a bit, but our loss from operations nearly doubled. And let's see what happens for 9 months. Not quite the same story. Went from a $32.5 million net loss up to 49.9 loss from operations. So it was a bad quarter. I'm going to say bad quarter, but it was a quarter where this general administrative expense really accelerated. We see here, if you want to annualize this out, you're close to 75 million. Notice for 9 months, it was actually at 56. And so if you times this by 3, you're at 60, you're almost at 70 million. So something happened in this quarter with this general administrative. Could be a one-time thing. That's what you would prefer as a shareholder, but that's something that I would keep in mind. The last thing you want to keep in mind when we look at the operations is they are diluting you quite a bit. We went from 93 million shares outstanding up to 105, and maybe that's 105. This might be as written. And we see here, look, we went from 59 up to 100, nearly doubled the share count over the last 9 months. Just again, something that you want to keep in mind. Now, I'm going to zoom down to the cash flow statements, which is a little bit lower. They kind of bury this a little bit. No big deal, though. Cash flows were positive for the most recent quarter because take a look at stock-based compensation. My guess is in that general administrative expense that I just went over, a lot of it was baked into this stock-based compensation. Now, you can come up here and probably see a little bit of it spelled out here, but I'm just going to guess off the top of my head that's where a lot of it was. So we pull down our 50 million net loss here. We got 37 in the previous period, but our cash flows actually turned positive for the period, primarily because the stock-based compensation was just really, really hefty. And then finally, coming down to financing activities, we see here proceeds from a follow-on public offering. So what happens is a company goes public, they issue a certain amount of shares, or insiders sell a certain amount of shares when a company goes public. And then what often happens is you have what's called a follow-on public offering. So later down the line, 6 months, 12 months, however long it is, you come back and you sell even more shares. And that's what Fastly did. And so it's just something you want to keep in mind. That's a lot of shares, but it did bring a ton of cash. This is where all that cash that we saw on the balance sheet, this is where it all came from. Because you see here, yeah, we made a little bit of money here from our cash flows from the business, about 11 million, but then we gave it all back basically in our investing activities, 7.5, and then we got a ton of it back, 290 million here flowed to the cash in terms of our financing activities down here. So those are the things that I see with Fastly. Let me get back to our question, make sure. So look, I would hold your 50 shares. I wouldn't be I wouldn't worry at all about this company. Can it go up and down? Yes, this has been a very volatile stock. You see it's been up here at high as 128 and as low. Look at the 52-week range. It's been as low as 10 and as high as 136. So, fasten your seatbelt with this one, okay? It's going to go fast, like the ticker symbol kind of says. And if you can stomach that type of thing, then by all means. It looks like to me, I don't have the chart up here, but it's right here at a level where, you could step in here and buy if you wanted to. Personally, I like to see these companies get a little bit more mature. I don't necessarily have to be early. Obviously, if you're in here at the $10, $20, $30 range, you're doing great with this one. I don't mind to see this one mature out a little bit, grow into this valuation, and then you can step in here. We do see 17% short interest, so there's plenty of people betting against this one as well, likely just because it's such a volatile stock. It's one that's going to attract traders and things like that. So that's Fastly. I'll try to add this to, it's an interesting stock. I'll try to add it to our regular rotation. They just reported earnings. It looks like just at the tail end of October. So another 3 months from now, they'll report earnings again, and I'll try to add this to our rotation because it's an interesting stock. It's a high flying stock, and it's a good example of a young public company and one that's probably trying to work and grow into its valuations. And so we'll talk about it more here on the channel. Hopefully I helped answer your question there. Next question coming in here from Kyle says, thanks for all your videos. Can you do an analysis of HYLN? I think this is pronounced Hyliion Holdings Corporation. They just went public, or they went public via one of these special acquisition corporations, or SPACs as they are known. We see here the stock really popped, and then it's kind of come back down to earth a little bit. And so what I'm going to do is I'm going to put this on our regular rotation, because when we jump into the numbers, there's quite frankly not a whole lot to be seen here. This is what I call a press release company. This is a company that's going to have to continue to put out press releases and put out stuff that keeps investors enthusiastic about the stock, enthusiastic about the story. Otherwise, this stock will fall out of favor, like we've seen many times in my investor journey. There's always been companies that kind of come to market pre-revenue, pre-product, and then they tend to fade out. Now, that's not necessarily going to be the case here. You just want to keep that in mind. I would keep this inside a very speculative portfolio and position yourself accordingly. We see here 9 months ended here, 19 over 20. They don't even show any revenue, okay? They don't even show that as a blank line because that's what it is. They just jump right into expenses here. We see our expenses here went from about 8.7 up to 11.9. Not incredibly amount of jump in terms of expenses. We see here weighted shares outstanding. I'm surprised this didn't go up a little bit higher, but we're basically diluting you a little bit and we're losing money on the top line. On the bottom line, there is no top line on this company. When we come to the balance sheet, not as healthy as I would necessarily expect a company of this early stage to be. They do have $7.5 million worth of debt. Of cash. They have $7.5 million worth of cash, but they do have a current portion of debt at a $28.5 million. My guess is they might work to wipe that out. I'm not exactly sure if they're going to wipe that out with some of the money that they raise at some point in these markets, but my guess is they'll probably work on that as well. So not a lot from a balance sheet perspective. They have far more. Take a look at this. Total liabilities, $55 million. Total assets, $18 million. We call this company is literally underwater. Okay. If this company had to liquidate, they would be basically completely bankrupt. So from a operation standpoint, absolute disaster. They don't have any revenue and all they have is expenses. From a balance sheet perspective, also a complete disaster. They have $19 million in assets and they have $55 million in liabilities. Again, just compare this to your own personal, forget other stocks. If you had $18,900 in the bank, but you owed creditors $55,000, you probably wouldn't be sitting around feeling great about your financial position. And then finally, moving over to cash flows, we pull down our net loss and then we kind of see what's going on here. We've got some debt amortization here, very little share-based compensation here. My guess is that will probably rise. We've got negative cash flows here of about 11 million in the most recent 9 months. Then finally, we come down here, we see proceeds from a term loan. So they did these term loans here at 10 million. Just not a whole lot going on here. This, in my opinion, is a very, very speculative company. If you believe in the story, if you believe in what they're doing, their products, certainly you can take a flyer on this one. But again, you have to hope that the market just stays interested in the story, in the press releases. Okay, yes, we have shining examples of that in the market, maybe like a Tesla, maybe like an Amazon, maybe like some of these other companies that are out there. But there is a complete graveyard of companies that did not make it to that level. And so that's why you just want to be careful with these companies. Not saying it's a bad company, not saying they should be anywhere different than where they're at. Okay. They have an emerging product. They're working on it. Their balance sheet is a complete disaster. Their operations are a complete disaster, but it's not completely out of line. Okay. Lose $11 million in 9 months is not completely just burning through cash. I mean, it is burning through cash, but I've seen more egregious levels of this. Now, what you want to see in the months ahead, I'll add this stock to our regular rotation. So in another 3 months or so, when they file another quarterly earnings report, I'll add these guys to that and we'll see how they progress. You know what I mean? Like we'll see, I'm not expecting any type of top line revenue to be over and above, but what you want to see is how these costs are controlled. When they become public, executives tend to just start spending money like they have an unlimited balance on a credit card. So they start buying a bunch of stuff, spending a bunch of money in the hopes of generating enough kind of interest in the stock to keep things rolling. So I'd keep an eye on that. I'd keep an eye on your weighted number of shares outstanding. And then eventually you'd want this balance sheet to get cleaned up at some point, okay? We have very, very little on the asset side and actually a fairly significant amount on the liability side. You just want to be careful because maybe this company went public because they were looking at this balance sheet and they were running out of options, because banks look at this too, okay? Banks are going to look, you have 55 million in liabilities and you have 19 million in cash. So, or in assets, there's just not a lot of banks out there that are going to be running out to help, supply money for this company, because they're going to need a lot of it going forward, because I still think their products are still a ways out from generating lots of revenue, lots of profit. So there's some things that you want to keep in mind. It can be a stock that you can trade. It can be a stock you can hold. You just want to be aware that these speculative stocks can be flavors of the week and can go stale very, very rapidly. And so you just want to allocate yourself accordingly with these stocks. So thanks for that question, Kyle. I will keep you updated on this stock as we move forward into next year as well. Next question coming in from Kenneth. Thanks again. You are my first priority when I check the new YouTube videos. I appreciate that. Man, it's somebody sitting here. That's very humbling. I appreciate you guys watching these videos. That's why I try to do these Q&As to try to help you guys out as much as possible. Would you mind talk about how to hedge the market drop in practice? For example, I bought VIX, VXX, and I expect it to rise when the VIX rise. The VIX is like a volatility index, and I'll show you here on the price chart here what it looks like. And then finally, is it true that is there a better way to hedge? So first of all, I don't typically short stocks. I don't typically short the stock market. So I'm going to just preface all this. I am by far not an expert. There's going to be much better research out there on this, but I think I can help point you in the right direction. So don't think that I'm going to, send you astray here or give you bad information. First of all, the VIX, in my opinion, is a trading vehicle. You want to be in and out of this one, okay? I would definitely be in and out of this one because we can just see the stock chart. This thing pops and it drops. It pops and drops, pops and drops, pops and drops. That is the MO of this. This is not something I would hold more than a day or two at the most, because you can see this thing rallies and then falls off. We see I'm in a downward channel here for several months. We could probably squeeze this chart out even higher. Again, this thing pops and then it just drops. Okay. So in my opinion, yes, if you want to kind of day trade the drops in the market, the VIX might not be that bad. The other thing you could think about is all the indexes tend to have an inverse ETF. So for the QQQ, which is the NASDAQ, it's QQQ is like a NASDAQ ETF. Well, there's SQQQ, which means you're basically shorting it. And again, the same advice to the VIX. I would not hold this one because take a look. I'm on a weekly chart. Look at this. Would you want to be long this ETF? Absolutely not. Look at all the volume down here. So just absolutely is falling off a cliff. Maybe it's rounding and it's going to bottom and it's going to start to rise. I don't know. I just think that it's dangerous to hold. I mean, you can just see, we can zoom this way out. Look how terrible this would be to hold. Okay. And so this is something that if you have a belief or anything that you want to short, I would look at it as a very, very short-term thing, because I think there's a stat out there, I could be wrong about this, but markets go up about 70, 80% of the time. So to play the short side needs to be a much, much shorter term. You see, when this stock rises, I'm on a weekly view here. And so this stock, this ETF, the short inverse ETF, yes, it rose here. It went from about 238 up to about 397. I mean, that's great gain. But you would have gave them all back in just a matter of a few weeks if you held on to it. So you want to be in and out of these. My opinion is a better way to play drops in the market or sideways action would be the options market. Now, I have traded options. I have an account where I trade options, but I am nowhere near a level of ability to explain that and give you guys advice on it. And to be honest with you, I've been reading books, watching videos, taking courses on options for 5 or 6 years now. And I have put it into practice. I've traded some options. I've done some different kind of option strategies. And in my opinion, it is a great thing to start to learn about and add to your toolbox. I just personally don't feel confident enough yet to come on here and start giving it my advice or giving you my experiences until I get even more experience under my belt. So that should tell you something. I have been studying options, trading them, occasionally for the last 6 years. I still don't think I'm ready to kind of really use that as a full-blown strategy inside my portfolio. But if I were to play more market drops, in my opinion, the option market's where you want to be. So I would spin you off to other YouTube videos, other YouTube channels, go down a rabbit hole and start, learning the different option strategies when markets go down or go sideways. You can sell for premium. You can play sideways action. You can do straddles. You can really protect yourself because, again, markets tend to just go up, but you can bet on them going down and really mitigate your risk inside the options markets. So that is how I would play this one. Hopefully I helped answer your question there, Kenneth. Moving on, Mr. Kim says, can you be bullish on both bank stocks and SQ? SQ is Square. Also, Jack Dorsey's kind of payment processing stock. Considering SQ is supposedly to hypothetically disrupt traditional banking, love the channel and the content. So I would say absolutely you can be bullish on both bank stocks and SQ because here's the thing about bank stocks. Like if you think about Bank of America or JP Morgan, they do so, okay, the money, the SQ, I would guess if you have a Square account, you probably have a bank account, okay? Or you probably have a credit card or a debit card attached to that. Banks are not going to go anywhere. Now, I'm not saying they're necessarily going to be a great performing asset, but banks are the cornerstone of kind of the financial system. They're basically in bed with the Federal Reserve as well. The Federal Reserve could not function without the big money center banks like Wells Fargo, JP Morgan, Bank of America, Citigroup, and the rest. And so yes, I think you can be both bullish and, liking Square stock, but also have bank stocks in your portfolio. Is Square disrupting their market a little bit? Sure, but it's not, in my opinion, not going to replace banks in general. When you look at payments and how money moves through the system, it's still believe it or not, the vast majority is we still live in a cash-based society. Anytime you have cash, banks are going to be playing a very large role in that. I also think there's a stat that, a large percent, especially when you look at low income and minorities here in the United States, that group of people tend to be underbanked. I've seen stats where 40-50% of that group of people doesn't even have a bank account. Okay. And certainly you go drive through the poor neighborhoods or the bad neighborhoods, wherever you might live, you're not going to see a bank. And so there are problems here in the system. There's probably some more room for bank stocks to grow and also Square to grow. I think there's enough money and enough financial transactions inside the system that both of these could potentially be winners in the future. Moving on, do I ever look at overall money supply to predict market movements? This is a good question. So not necessarily the stock market, so like equity markets, but money supply. When we talk about MS, yes, you could probably use that to be a little bit of a predictor, like on bond prices, interest rates, how money is moving through the system. I think in general, if you want to take a big macro view, you will look at things like money supply. You will look at lending, how much banks are lending, like lending standards. How is credit moving through the economy? And the better that stuff moves, obviously, the better markets tend to be. We live in a debt-based society. So the more debt is being pushed through the system, then obviously the better that the companies are going to be at extracting that money out of consumers and people that are borrowing and then spending that money. So in general, yes, but I wouldn't say specifically. I won't say that, hey, if money supply goes up, that's going to be bullish or bearish for stocks. If money supply goes down, that's going to be bullish or bearish for stocks. Now, if you can pull up a graph and see a correlation of very, very long history, 10, 20, 30 years, where that correlates, sure, then maybe, maybe it does correlate, because we can probably pull up, money supply and the amount of money in the system has just been kept getting pumped and pumped and pumped here in the United States. And sure enough, stock markets have moved up as well. But in terms of individual stocks, when we're talking about maybe like an Amazon or, an Apple or something like that, I wouldn't necessarily look at a macro event or a macro kind of money supply indicator and then apply that to a single ticker. But in general, the markets tend to like more money supply. They like more debt. They like stimulus and things like that. So you can draw some conclusions there and make some connections there. But again, any economics professor will teach you there's no free lunch, and there's always pushes and pulls on both sides. So it's something that you want to keep in mind as you analyze these types of things. This is a good question. This is one we could talk about for a very long time. Next question coming in. Great video as ever. Thank you. No, thank you. Next time, maybe talk about leveraged ETF pairs like JNUG and DUST and SPXL and XPXU. Okay, so a leveraged ETF, for you guys that don't know, tend to trade like they want to go like this one. This JNUG is 3 times the gold miners. So they take an index or take like a basket of stocks, and for every dollar that the gold miners moves, this JNUG or this leveraged ETF will move typically in 3x fashion. So what I will say with these is, you can see these big moves. Look at this big, gigantic down day. We went from 1048 all the way down to $50. I'm on a weekly chart. Let's zoom this out to a daily and kind of see these big drops. I mean, look at this drop again. We went all the way down here. Now this thing's kind of flattened out a little bit. So those are some things that you want to keep in mind with these leveraged ETFs. In my opinion, these are just like what we just talked about with in terms of shorting the market with the VIX or with SQQQ, something like that. These are trades, and you want to be very, very, very careful. Now, have I traded stuff like this? Absolutely. The last time oil, not recently, but 4 or 5 years ago, oil went way in the tank. I think $20, $30 a barrel. The last time it tanked. Well, I traded it to the upside with a leveraged ETF, but I was in and out in one day. I never, ever held that stuff overnight, because some weird stuff can happen, and boy, you can get on the wrong side of this. So if you're going to trade stuff like this leveraged JNUG or DUST or SQQQ, any of the leverage stuff, you just want to make sure you have your technical analysis on point. You want to pick out your levels, and you definitely, absolutely need stop losses with these things. Okay. So for example, just on this JNUG, I see we're channeling down here. We're in the middle of the channel, which is not necessarily where I'd want to step in. I'd want to step in at the bottom of these channels. Take a look. We've bottomed out on this channel a few times. So as this stock came down here to the bottom of a channel, I would look to buy down here, but I would put a stop loss very, very tight underneath this. So let's just say I bought this at 105. I'd put a stop loss at 100, okay? Or maybe even a little higher than that, because if you break this trend, this thing is probably going to collapse very quickly. Again, this moves 3 times the index that it is tracking. And so it is going to move, and it is going to move quick. And so I would buy it here and then wait for it to pop a little bit. And maybe if it pops back up to the middle of the range, unload about half my shares or a percentage, and then maybe let the rest ride to the top of the range, and I would get out. That's the key with these things. Once you get a gain in this, get the heck out. Lock in your gains, get out, wait for it to drop back into a zone that you're comfortable with buying, buy back in and drop, pay the pops and drops with these things. That's what I would say. Okay, do I have the lifestyle where I can trade these things? No, I have 2 young kids. I'm with them, 24 hours a day. They both don't go to school or preschool or anything like that. So I am taking care of them, a large percentage of the day. I cannot afford to buy this down here and then watch it break trend and watch it go. Okay, so maybe when my kids are a little bit older, I have more time to sit in front of a computer screen and analyze these things. Something like this, sure, if you have that lifestyle. Also, I wouldn't necessarily recommend this for somebody that is just learning. If you want to start learning on this thing with trading commissions being free, I would buy 1 share. Buy 1 share here, watch it go, sell your share. Buy 1 share here, maybe get stopped out of it. Learn how to put your stop losses in place. Learn how to trade this thing. That's what I personally would do. You'd probably also want to trade this maybe like on a 60-minute time frame or a 30-minute time frame. Look at this at tighter intervals and then trade it on these intervals. You're going to have these big gaps. I mean, look at this, how this thing gaps up and down. That's why you want to be careful about holding something like this for more than a day, because it will, look at this just gigantic gap. You went from 144 all the way down to 130. I mean, that can blow up your account if you don't know what you're doing. So just be careful with these kind of things. I'm not going to tell anybody not to trade these things. Just know what you're doing and take it slow. If you're new and you're just beginning on these things, do it 1 share, 2 shares at a time. Learn how to set your stop losses. Don't worry if you take a loss on a trade. That is actually a learning process. Taking losses on trades, learning how to take a loss when it's good to take a loss, and then learn how to exit the position as well. So that's what I would say with these. Not that it's not something I trade or buy on a regular basis, but it is they are interesting if you have the time and you can sit in front of your computer screen and trade these things. I think they're pretty fun, and quite frankly, if I had a little bit more time, I'd probably play around with them a little bit more. Next question's coming in from Golden Ratio saying, great video for 20 stocks next week, ACB, CGC. Thank you. So we'll take a look. Now, there's a reason why I haven't really covered these stocks on the channel. One, I just don't, when we look at these financials, you'll see why I don't invest in any of these companies. Also, their market is dependent on whatever government regulation. Basically, a government or a state has to allow this company to sell their products. And I hate businesses like that. In my opinion, you're always going to be capped on the growth that your business is going to be able to achieve if you have the government involved. So let's jump into it. Aurora 420 stock here. We've got a revenue of sales good here. It came in flat year over year. That's a problem. When we also jump over to the stock chart, you see the air has just come completely out of these stocks. This is why I also caution you on right now, the alternative energy, the EV space. It's super hot right now. Well, look what happens when the air comes out of the space. That could potentially happen as well. At one time, you turned on CNBC and they wouldn't go 30 minutes without talking about one of these stocks. Now they probably haven't covered these stocks in several months. So here's this company here. ACB, we've got revenue again coming in flat. We had 82 and we're at 82. Now, unfortunately, look at the tax here. We're coming in with taxes. That's the other thing I don't like about this business is even when it becomes legal, they tax the absolute crap out of these guys and the product. And to me, that's not a good combination. And so you see here, net revenues actually down year over year. So that's a problem. Cost of sales came in a little bit higher as well. We get a gross profit number at 26. Again, we came in flat on our top line, but our bottom line here at gross profit, or a semi-bottom line, is at 26. It was at 44, so that's a problem. That's also why when you look at a stock chart of ACB, it's absolutely kind of fallen off a ski slope here. Now, moving down, that's not the end of the story. We've got some other cost here as well. Now, I will say they've done a nice job kind of containing these, and you take a look at general administration, actually went down almost by half. Sales and marketing went down as well. Everything went down, and it's nice. It's nice to see that. Unfortunately, it leads us to a loss from operations of $42 million. This might be in Canadian dollars as well. So that's just something to keep in mind when you look at these figures for ACB. Now, for Canopy, which is CGC, same story with the stock. It was the darling. It was talked about all the time. You could go to every YouTube guru and all they would, once a week they were posting a video about the stock, and well, it's fallen off a cliff. Now it has rebounded nicely. It's pulled back up into a zone here, which is kind of interesting. We'll take a look at the financials. They must be doing something a little bit better. And when I take a look at the top line, I actually see that we went from 85 million. This is also in Canadian dollars, up to 150. And so that's actually solid growth from Canopy. We see for the 9 month, you're getting that kind of growth as well. We're seeing those taxes, they're growing as well. And don't ever expect the tax to go down. It's only going to go up with companies like this. So I don't like that in particular. We come down to a gross margin here. We were at 3.6. Now we're up to 26. So that's really solid. So from the top line perspective, top line growth, top line gross margin, everything looks pretty good in my opinion. We're up to 32.5 for the 6 months ended. Now, unfortunately, that's not the end of the story. This company has massive amounts of expenses. Take a look at their selling, general, administrative. It went from 181 down a little bit to 147, so that's good. But look, we had a gross margin of 26 and we spent 147 just on selling G&A. That's not great. Share-based compensation ticked down a little bit. We've got some credit losses here. That's potentially a one-time charge. It didn't happen here, so we can almost throw that out, I guess. And asset impairment too. We've got about 150 in these asset kind of credit losses here. Wouldn't necessarily expect these to repeat, so you could come down here to operating expenses and potentially, if you wanted to, kind of cut this in half if you want to adjust these numbers and project maybe a year out, 2 years out. So you could cut this in half, but that still leads you at a massive operating loss because we only made 26. And even if you cut this in half, we're still losing tons of money. When you come down here from a net income perspective, we made 258 and now we lost 32 million Canadian dollars in the most recent 3 months. You see for the 6 months ended as well, it's pretty bad. Now, what I can expect is management has probably been communicating these restructures, these impairment charges pretty well to investors, and they're giving them a kind of a pass on it. The stock has ticked up. It is kind of gone down recently into the $13, $14 range. Now we're closer to 25. So personally, I don't like these stocks because, like I said, the government or the state or whichever it is has to approve you. And not only are they going to approve you, but they're going to tax the living crap out of you. The second thing I don't like here in the United States market, it is still I don't know what the Schedule 1 or, it's still considered a very, very illegal drug from the federal level. And until that gets cleared up, I would personally stay clear of these stocks. And if you take a look at the stock charts, there's not much here, especially with ACB. This stock is just completely taken a dump. Now, can you trade this thing? Can it pop and drop and those kind of things? Of course it can. Can you build a long-term portfolio around a stock that has done this? I don't think so. This to me is something that you trade, something you put in the speculative basket, but that's where it's at for me. There's a reason why we don't necessarily cover these stocks here on the channel. It's just, in my opinion, not a great from a long-term growth perspective. Also, these companies have been the darling at one time and they've fallen out of favor, and they've just done exactly what a lot of people thought they would do. Just burn through cash, burn through money, and dilute shareholders and not really be a great performing stock. And it's just for a number of different reasons. While it's a decent sector, is there money to be made? Sure. I don't think from a public markets perspective, I don't necessarily think these 420 stocks will be anything other than a speculative investments. Again, that's just my opinion. Next question coming in. What's your strategy to start thinking about selling stocks? Okay, we can actually take a look at the stocks that we just kind of analyzed. So let's say, for example, I was in CGC, and let's just say I bought it down here. I bought it kind of on the initial upswing. I bought it at 25. This would have been 2 years ago. And then all of a sudden, the hype begins, and this stock starts pumping, and CNBC and the YouTube guys just start pumping this stock. It gets up to 40, 50 bucks. I've doubled my money. I'm feeling great. I'm feeling like I'm Warren Buffett Jr. Well, then the stock starts pulling back. Well, I would start setting levels where I'd want to exit this one. Just right off this chart, what I would do is I would have put a stop loss probably right here when this stock was up here, especially on these speculative investments. Now, I know some people might have a longer term view on CGC's product and things like that, but personally, I once the market fell out of favor, once the numbers don't look good, you can see how much cash they're burning through. Well, you stick a stop loss under it here. Maybe it's down even lower. Maybe it's down at this level, and then you don't really make a whole lot, but you don't lose a whole lot. Now, let's just say you got this stock at 25, it came up to 50, you thought it was great, and you start writing it down. Well, then, yeah, maybe I'll set a stop loss down here and actually lose $1 or $2 on a share. When I start thinking about exiting a stock is when the tide changes, when the market changes. I'll give you another example of a stock that I've actually sold. I've rarely sold out of my 401k, my IRA account, but this is one stock that I did. So I bought Limited Brands, which is the maker of Victoria's Secrets and Bath and Body Works, and I bought the stock a while back. I mean, it was probably right after the 08-09 crisis. I bought it somewhere in here, $5 to $10 a share. This stock rallied all the way up to 100. I thought I was an absolute genius. I think I had 30 or 40 shares at the time. Well, things started happening in the marketplace. At one time, Victoria's Secret had very little competition. It was by far the number one market leader. And then I started seeing new competition pop up, new advertisements for new competition. Then management made a series of bad decisions, in my opinion, for Limited Brands. They cut off the catalog. They weren't marketing as well as I think they could have. And this stock started to come down. And I actually set a stop loss I think it was right in this range, right above $55, $55 per share. I set a stop loss. I got stopped out. I basically got out of most of my shares. While I kept a few because they do pay a dividend, I basically got shares for free over the years. And so I kept a small portion of it, but I basically got all my principal back, and then some, but I exited this one. When the market changes, okay, their mall properties weren't nearly as good as they used to be. Their product wasn't as good as it used to be. Their marketing wasn't as good as it used to be. The management wasn't as good as it used to be. That's when you got to learn how to cut bait and get out. Now, it doesn't happen very often, but it can happen. And here's an example where it did. Now, did I get out at the absolute top? No, I didn't, because even up here, I thought, look, this company probably could still do well, but they started making a lot of bad mistakes. And this stock, as you can see, just has tailed off. Now, it's peaked up again, but this is not a stock I would want to jump back into anytime soon, just because I still think management and things like that are not doing well. So when do I start thinking about selling a stock? I think they might be talking about like a longer term, perspective. I was going to hold this stock for a very, very long time. If the markets didn't change, if their products didn't change, if their marketing didn't change, I would still be holding this stock. But all of that changed and I had to get out. Now, if you're trading stocks, you should have this all planned out right when you buy a stock. So for example, if you bought this stock down here at $18, you should have it all planned out right when you buy it at 18. You should say, I'm buying at 18. I'm setting a stop loss down here at 7. And then I'm getting out, or I'm setting trailing stops as it gets up here to 29 or 30. I'm not saying that's exactly how you'd set up this trade, but that's the process you'd want to have. You want to have an entry, you want to have a stop loss, and then you want to plan your exit. Do not turn trades into long positions. That is one of the cardinal sins that a lot of rookie traders or rookie investors tend to make. They'll maybe buy the stock up here. Like, so say this big red candle, we came in here and bought it saying, oh, it can't go down any further. It kind of pulled into like a little supply zone here or a demand zone down here, and it's not going to go any further. Well, you bought it at 37, and then all of a sudden now it's down here at 16. And now you're saying, oh, I'm long the stock now. Now I'm long, I'm going to hold it. No, you just turned a trade into a long position. The proper thing to do is pick a level where you're going to buy it, pick a level where you're going to get stopped out of it if the trade goes against you, and then plan your exit as well. Start setting trailing stops. Most traders that I know that are professionals and do this for a living put that all in at once. They literally buy the stock, put the stop loss in, and then put their exit all at one time. So there's no decision making after the fact. In my opinion, that's probably the best way to do it if you're going to trade. If you're holding for the long term, you need to analyze things from a fundamental perspective. And when you got to think about the reasons why you bought the stock. I bought Victoria's Secret's limited brands because of their marketing, because of their brand, because of their strength inside those markets. And once all three of those things started to deteriorate, it was time to move. Next question says, how do you determine the value of a stock that you want to buy? Is it valued, overvalued, or undervalued? And so it's a good question. And I'll tell you what, there's probably people out there that pay more attention to the quote unquote traditional valuation metrics, like a price to sales, price to earnings. I don't typically buy a stock solely on that reason. Let's take a look at Amazon here. I've got a 10-year view on Amazon. I've got it from a price to sales basis because Amazon hasn't always turned a profit. We can see here, Amazon is trading at an elevated price to sales ratio in comparison to itself. And if you're going to look at price to sales, price to earnings, I would typically compare the stock to itself instead of comparing Amazon to, say, a Walmart or an eBay, where the comparisons might not be as good because while they're in similar businesses, Amazon has a lot more businesses, Walmart has a little bit different business, and eBay has a different business than all three. And so I would not necessarily say, well, Amazon's price to sales earning ratio is lower than Walmart's, for example, so Amazon must be undervalued or fairly valued. I would never look at it from that sense. This is just one tool in the toolbox. Obviously, if Amazon pulls down in price, that is what I am more focused on. And so when I'm focused on what I'm going to buy, let me come back here and look at this question. How do you determine the value of a stock that you want to buy? So what I'm looking for, it depends on the stock. Okay. A stock like Amazon, I am looking for capital appreciation. Okay. Because they pay no dividend. I don't think they have a stock buyback or anything like that at the current time. And so what I'm looking for is a chart that is going to look something like this, that is just going to be a straight line up in the air. This is what I'm looking for with Amazon. Now, do I need to dig into whether it's undervalued or fairly valued or overvalued? Sure, I guess you could do that. But in general, I am looking for this type of growth. And this type of growth more or less comes from a fundamental story, not necessarily a valuation story. I hope that makes sense. So from Amazon's perspective, the fundamentals and the valuation has always been kind of out of whack, but the story and what they're executing on has actually been always really, really strong and really captivated investors. So from that sense, I don't really pay attention to valuation with Amazon. I just make sure that their story and their growth trajectory is still intact. So with someone like Amazon, I am absolutely just taking a look at the financials, making sure they're growing that top line, make sure they're growing their businesses and expanding it at a rapid rate, make sure they're reinvesting in their business as well. As long as they're doing that, I will be very, very happily an owner of Amazon. Now, a different story might be a stock like AT&T, a stock that we've covered pretty well here on the channel. Now, with AT&T, I'm not necessarily buying AT&T for capital appreciation. So I'm not necessarily trying to buy it at 30 and having it go up to 50 or 60. We actually see that this is a max chart of this. This goes back to about 2000, 2002. You actually can see this stock peaks out at the 42, call it 43, $44 range, and it bottoms out down in here, not quite down here recently, not in the last several years, but this stock has come down into the mid 20s, low 20s. You could probably bump this line up if you want up in here to about where the stock is today, around $26, $27 per share. What I'm looking for with AT&T is just to stay in this range. And I want to buy it down at the bottom of this range because that's where I get the most for my dividends, the most money for my dividends. If you come here at AT&T and you take a look at the symbol, and you see that we're paying a 7% dividend yield on this one. So in my opinion, that's a pretty fairly healthy dividend. If you want to take a look at a valuation metric like price to earnings, it's at 9, which seems really low to me. You could always come over here too and kind of look at a price to earnings comparison of AT&T to itself. And you see here on a 5-year basis, it's basically trading about where it normally does, at least from a price to earnings gap basis. So, it all depends on what the stock is and what you're buying it for in terms of how you're going to evaluate it. So a stock like AT&T, which I'm buying for dividend yield and just income into my portfolio, reinvestment into the shares, I'm just looking for the stock to stay within its range. It's not super hard for that. With Amazon, I am looking for monster growth, monster reinvestment. I am not looking for profits. I'm not looking at traditional valuation metrics because, like I said, you can do a max view on Amazon. This goes all the way back into the 2000s. Does anywhere on this chart look like anyone's cared about PE ratio, price to sales ratio? Not really. Okay. This stock has just been a monster. And so I hope I helped answer your question a little bit. I know it's not I didn't give you like the traditional answer saying, hey, if the PE is 12 or if the PE is 20, it's overvalued or fairly valued. I don't think a lot of great investors actually do that. I think they take it into account what the stock is, what they're buying it for, and then start to make an overvalued or undervalued basis on that. And then you can kind of look at the stock chart as well and just say, hey, well, traditionally this stock is traded in this range or that range, and you can start making projections there. Hopefully I hope answered that one for you. Next one's coming in from Christopher. Hello, I really enjoyed your video and watch everyone. Appreciate that. My question is, with a 10-year view, how safe are the airlines? I'm specifically looking at LUV, which is Southwest Airlines. So this is a good question. So I actually had my mom set up a stock portfolio for my kids or her grandchildren. And she was, obviously she asked me about, what kind of stocks that they should buy. And one of my things was, obviously I rattled off the names that I think are obvious, like the Amazons, the Apples, the Microsoft, a lot of the stocks that we cover here on the channel. But I also said, let's mix in some stocks that are absolutely completely beaten down right now. And I mentioned Boeing, which has performed very well since I suggested it to her. So I look good in my mom's eyes. I guess that's good. I also suggested the airlines. I suggested Southwest Airlines because in my opinion, Southwest Airlines, when you go, I'm not going to bring up the balance sheet here, but if you guys want to, it is relatively healthy. They are looking pretty good. I also like Southwest value proposition the best. When the airlines come back, everybody's going to be under pressure in terms of pricing, and that's always been Southwest Airlines' strong suit, where some of the other airlines have had to rely on maybe higher pricing or international flights and things like that. They're going to have to bring their prices down. Maybe their cost structure doesn't allow for that. Whereas Southwest Airlines, that's the game they've always played and will continue to play. So I think they'll continue to have strength in the market. They'll also get strength from their competitors being very weak. And so a lot of competitors in the airline segment have gotten weaker over the last few years. And so that, or really the last few months, and that should help Southwest Airlines. Now, with a 10-year view, I don't have any problem with it. You know, you might have to stomach some turbulence, so to speak. So that's just something that you want to keep in mind. But with a 10-year view on the airlines, especially a very, very healthy one, not necessarily a speculative one, I don't mind it at all. Let's take a look at the chart, though. Let's see where this one's at right now, because it's one I haven't. The chart actually doesn't look too bad, quite frankly. So we're on a monthly view here, and obviously we had this big decline, but quite frankly, we've actually almost come all the way back up and recovered it. So this is actually looking pretty good from a chart. I want to say it looks pretty good from a chart perspective, because we're still in a downward trend here. We haven't retested up here at the 50-day moving average. When we did, it got rejected. When we come up here, I would expect this stock to, I honestly would expect this stock to consolidate in this range that it's in right now. Quite frankly, I would expect it to be in this range right here, 35 to 45, right in this box, because you see it consolidated here, kind of blew up and then kind of dropped. Anywhere in this ballpark, you could even drop this down here if you wanted to, $30 to $45. I would just expect Southwest Airlines to channel in this range. Now, if it pops up, great. If it doesn't, I would expect for it to be in this $30 to $45 range. If it's in this range, I wouldn't worry at all, especially with a 10-year view. If you want to be safe and put a stop loss down in here, $25 a share, because if it breaks that level, it's probably coming down much further than that. But anywhere channeling in this range is an interesting spot. It is going to hit resistance, though, because all these buyers up here that bought pre-health situation are dying to get out of this stock if they haven't already. So as this stock comes back up in here and these people can get even or make a few bucks on their shares, they're going to unload them, okay? Not all of these people, but a good amount of these people are going to come in here and unload these shares if they haven't already. And so you're going to hit some resistance here at the 50-day. You're going to hit this, downward kind of trend line that we're in. But all things considered, not a bad long-term investment. With the sector that they're in, I have no problem with that. Next question. This one's coming in from Kathy. She says, thanks for another great video. To follow up with what you said regarding Ray Dalio's allocation, what's your thought if someone had to take all of a 401k to an IRA now with a balance of roughly $200,000? What's the best way to allocate it into a portfolio right now? Is it worth to do weekly averages over a long time, since the cash is basically zero return? This is a good question. I'm going to have to be careful how I answer this, because I can't necessarily tell you exactly what you should do with $200,000. I'm going to hypothetically answer this as if I had $200,000 and I needed to allocate it somehow. And now I'm also going to base this, I'm not exactly sure how old you are or what your risk tolerance is or your time frame. Those are other things that you'd want to factor in here. Let's just assume maybe Kathy is close to retirement, okay? She's 50, 60, 70 years old. Well, the way you allocate this 200 would be completely different if you were, say, 30 or 35. It would be a lot different. Or even in your 40s, it would be a little bit different. I'm going to answer it from my perspective. I'm right there. I'm very close to 40 years old. I would answer it in this sense. So I got 200,000. Now, I would do really actually kind of what you said, a weekly average or a monthly average over a long period of time. Now, I wouldn't necessarily keep the 200,000 sitting there as a balance in my account that earns 0% or 0.25% or whatever they're paying you for this cash. I would invest it in some shorter term things, okay? And maybe some things that pay a dividend, maybe some things that I put a stop loss underneath, but also shorter term duration bonds tend to be where I hold my cash. So anytime I have some cash, like for example, I had some cash set aside this year for some real estate investments and also for some home improvements. And I wasn't sure when I was going to use that money, so I just put it in shorter term duration treasuries, and I was earning about 1 to 2% on my money. I know that's not a lot of money to earn, but it was better than just having that money sit there as well. So I think that's what you do with some of the cash. Okay. I don't necessarily think I would just go unload the clip on 200,000 with markets where there are, with where we are with the health situation, with where we are with the political climate and all those things. I wouldn't necessarily run out there and unload the 200,000. I would do exactly what, like you said, maybe weekly, maybe monthly. I would wait for maybe pullbacks in general. You can come here to look at maybe like a QQQ, which is really just kind of a broader view of the NASDAQ. And we can pull this up to maybe more of a weekly view here. And we see we've had some big pullbacks. This was in March, but then we've also had a pullback here. We've had pullbacks here. I would wait for those chances as well. Because as you pull like this NASDAQ chart back, you see multiple times we've had big weekly pullbacks, pullbacks. Anytime the market pulls back is when I would be looking to acquire companies or stocks or funds or ETFs that I was interested in buying. I wouldn't necessarily buy them when they were on these big, massive runs. Now you could call this a big, massive run, but I would let you guys decide on whether or not that, these pullbacks up here are deep enough for you to want to step in and buy these things. This is the NASDAQ. It's been running really hot. But so to answer your question, I definitely wouldn't put it all in at once. And depending on how old you are, what your time frame, what your risk tolerance is, I would definitely, allocate that with some care. Obviously, if I was older, closer to retirement, or needed, also another thing is needing this $200,000. When are you going to need it? Okay, those are definitely questions that you want to ask. If you're someone like me, you're 40, you might not, I hopefully won't need it for 20 years. Well, then I don't necessarily need to be as judicious on these pullbacks. Again, I'm not trying to time the exact bottom of these pullbacks. I'm not trying to buy on this candle down here or buy on this candle or buy in these candles. When this market was pulling back earlier this year, I was buying all along here. I was even buying as it started to rebound on the way up. Okay, I did a lot of buying right here, okay, in general in this area. Okay, same thing. When this market started pulling back here, I started buying in this area. Did I buy right on this candle? Probably not. I can almost guarantee you that I didn't. Okay, same with last week or so. When the market was pulling back 2 weeks ago or so, right before the election, I was buying right here. Okay, not necessarily on the bottom of these candles, but in this range, in this zone. And so that's what I personally would do. And then your extra balance, let's say you do 50,000 in the first month or two and you got 150,000 in quote unquote cash. Well, I would park that in something and do some research, find some, if anything. I know everybody says bonds and treasuries are these just absolutely safe investments. Well, the thing is they can go up and down in price too. And if you're not out there, here's like STIP. And so I'm looking this at a weekly view. This is back in, December of 2018. So this is about 2 years ago. We were at 97. And now we're up here at 103. But again, we could have bought this for 104, 103. Again, we're not losing a lot of money. This is something that kind of goes up and down. But you can see here in March, you would have got caught if you bought up here at 101. This thing bottomed out all the way down in the 90s. So, these things this is traditionally what's considered kind of a safer type bond investment. You just want to allocate carefully, maybe set a stop loss or two in these things. You are collecting a little bit of dividend on these things too. And so those are things that you want to keep in mind when you're allocating these types of investments. Next question coming in from Juho, I think. Hopefully I said that right. Reading mortgage REITs like MFA Financial. Thoughts on KRMD? Huge drop, no reason. So I had to go look at this one. KRMD is kind of like some kind of healthcare. So rule number one for me is I don't invest in individual healthcare stocks. I get my exposure through REITs, through ETFs with these ones. We see the 52-week range is $12 down to about 360. We're just above that. Another rule that I have personally for stocks is it used to be below $5. I bumped that up with the markets just ripping as hard as they have over the last decade or so. I don't invest in any stock under maybe even like $10 to $15, but definitely not under $5. Just a personal rule that I have for my own situation, not necessarily saying everybody needs to apply that, but for me, this would just be an absolute no touch just based on the fact that it's $4 per share. share. But that being said, let's jump into the financials a little bit. What I did notice is here's December 2019, here's September 2020. So here's a 9-month view. They have $32 million in cash, and the stock is valued at about $175 million. So that's telling you right there that the market doesn't really value a lot of the business, okay? Because you can minus this cash out of here, and you're at about $130 million worth of cash. And so they're not valuing the business at a whole lot. Now, that not much from the liability. I was actually expecting more here on the liability side. Not really. This balance sheet is actually pretty darn clean, to be honest with you. So there must be something when the balance sheet is this clean. It must be something from the operation side. And I am seeing some stuff here on the operation side. We see here net sales. They were basically flat in the most 3-month period. And so that could have investors not feeling that great. Gross profit also went down as well. We see total operating expenses actually stayed almost identical. So that's not necessarily a bad thing, but it's not a good thing when sales are basically down, gross profit is down, for your operating expenses to stay flat, actually go up a little bit. That's really going to affect your operating profit, which swung from, these are as written. So this is $825,000 and it swung down to about $359,000. So again, this is a company that's valued at $175 million, X cash, we'll call it 140, and they're generating just a shade over $360,000 in 3 months. You want to annualize that out, you're really at $1 million or two. Just give them credit for $2 million in terms of operating profit. That's not a whole lot of money. Honestly, there's some small businesses out there that are doing better than this company as. Now, they might not have $30 million in cash on the balance sheet, but it's not doing great from an operating perspective. Now, from the 9-month period, it paints an even worse picture, quite frankly, because their operating expenses actually went up quite a bit, and our operating profit went from a $745,000 operating profit down to losing $90,000. And so when you come down here from a net income perspective, it looks even worse because we lost $377,000 in the last 9 months compared to $644,000 in gains. So for the last 6 months, last 3 months, we went from $651 in profit down to $250,000 in net losses. That's not great. On top of that, you're getting diluted quite a bit. You had 40 million outstanding shares. Now you're up to about 44 diluted. And so that is some acceleration of some dilution as well. When you take a look at the stock chart, quite frankly, it's a pretty ugly one. Okay, we've come up here. The stock had a nice little blow off here, and it is just completely sold off. This is what you call a falling knife. Okay, this stock is just dropping. Now, it might catch a bid down in here, maybe $3.27. You actually can see that on the range. 360 is the 52-week low. Personally, if I stepped in for whatever reason on this one, I would have my stop loss set there right there at 360. That would be the absolute lowest. I think you could probably bump it up a little higher if you wanted to, but I would not let this one get under the 52-week low, because it gets under this 52-week low, man, there's not a lot to catch it down here. Really, the strongest level of demand for this stock is actually right here on all these little bars right here. That's down at $1.60, $1.75. So this one could easily get down there in my opinion. Now, this stock could easily get back up to $12. Okay, that's why I don't necessarily like these medical kind of healthcare stocks, is because their pipeline is all dependent on when that comes and when it goes and those types of things. And so I don't like to play that game. Also, it's a $4 stock that also goes against my rules. Not trying to say everybody needs to have these types of rules, but in my opinion, if you want to be a successful long-term investor, you need to have these rules in place, and they need to be hard and fast. And just personally with this stock, that's where I'm at with that one. Next question, kind of similar stock here. We've got, what do you think of coal stocks as a contrarian play, especially ARLP? Thank you. Now, I don't know if I would necessarily want to jump on a domestic coal stock. And by domestic, I mean here in the United States. Now, across the world in other countries, maybe coal is not as big a sticking point. But here domestically, it's just fallen out of favor, in my opinion, not just at the federal level, but from a state level as well. It's just going to continue, in my opinion, to fall out. Again, that's why it would be a contrarian play. Now, we take a look at the stock chart of ARLP, and we've seen this stock has been as high as, over $50, actually, close to $50 per share, but it's fallen on hard time. This is, a monthly view here, or excuse me, a weekly view. This goes back to 2012. Let me zoom this into closer to where we're at in the current level. And this stock has really just gone down a ski slope. Now it's flattened out here. And so, if you wanted to make this a trade, again, this stock is down at $3. I just talked about this. This is under $5. I wouldn't even look at this stock normally. Okay. With this question though, I will give you my analysis on it. So this stock I would put down here. So we see here the 52-week range. The bottom of the range is 263. The top of the range is 12. I mean, it's almost identical to the stock we just analyzed. Okay, I would put my stop loss right there around 263. I would not let this one get underneath that, okay, anywhere under here. Quite frankly, I would, if I zoom this in a little tighter, I think you could do a little bit tighter trend line. I would come in here at 309, 310. I wouldn't let this stock get underneath there because it probably would get into the 270, 260 range if it were to drop right below these kind of big set of candles right here, right at about $3.20 a share. So we're actually pulling into a zone where if you wanted to trade this one, sure, but I don't know what your upside is. Maybe back up to $4, sure, you could probably play it in that range. If you wanted to, personally, just not something I would be interested in from a longer term perspective. I just think these stocks have fallen out of favor. And I don't think, it doesn't really necessarily matter who's in charge here in the United States. There's always going to be one party that is going to be just anti-coal, okay? And they might be in a state where coal is actually being used a lot. And if the party or the attitude changes in that state, well, there goes your coal in that state. And the states that are using coal are getting smaller and smaller, as you can see by this business as well. Maybe from a global perspective, it might be a little bit better, but in my opinion, I think I would just steer clear of this one, especially this one, because it's under $5 per share. Your upside, it can perk back up into the 4, 5, 6. I mean, this one can come all the way back to 12, but in my opinion, it's just a little too risky for what I like to do. Next question coming in. We got one more after this. Could you please have a look at the stock GoHealth, ticker symbol GOCO? The earnings report was good, but the stock is tanking. So let's just take a look at the stock chart really quick. And this one actually just went public, or and the stock is actually reacting in a way a lot of IPO stocks have. And so they come out hot, they pop maybe a little bit, but then they get in this just downward channel. I see this a lot with IPO stocks, not necessarily the ones that get a ton of press, but stocks like this that are not necessarily very well covered or even very well understood, and they just continue to slide like this. And that's kind of where we're at here with this stock. Again, not necessarily the best analysis, but that's what you get with these IPO stocks. That's why I don't tend to touch these early IPO stocks. I wouldn't touch this stock as well, since it is in the healthcare space. But when we come over here to the statement of operations, what I notice here is this is really confusing. We have successor, predecessor, successor, predecessor. There's all these different time periods here as well. Look, these things are hard enough for the average investor to digest when they include, looks like maybe some previous iteration of the company and then maybe a company that is now considered the successor. It is just going to confuse the crap out of an investor. Just pull up an Apple, statement of operations. It is so clean, so easy to understand. it just makes this look like it's written in a foreign language. And to a lot of people that aren't, as astute to reading these things or investigating to see what this actually means, it's going to confuse them and it's simply going to turn them off, and they're going to go find another company to invest in. Now, what I'm going to focus in is the successor here, 3 months ended, because this has got to be our current earnings here. We've got Commission and Enterprise came in at 163, and it looks like it's okay. From the previous period here, we were at 19. So this company's growing pretty fast. Now, unfortunately, when you come down here to our operating expenses, we balloon those by a 10x up to $361 million. So we spent $361 million to make $163 million. That gives us about $200 million loss from operations. Now, whatever successor, predecessor, successor means, you can come down here and loss from operations. We lost 200. We lost 10.5. We lost 77 million. We lost 206 million. We lost 10 million. We lost 56 million. No matter what way you slice it, this company has continued to lose and lose money. Now, see, for the 3 months, take a look at this. 197, we lost $197 million from operations. That is the second highest number on this line, and this is a 9-month. This is for 3 periods of this. So if we have 3 periods of losing a $197 million, that would be over $600 million loss. That would be a big problem. I think investors are seeing that as well. Again, when we jump over to the stock chart, this stock broke down, it peaked up, and it kind of hit this resistance level right in this range. This is where I just monitor this one. If you like the story, you like the stock, I don't necessarily think, based on what I just saw in the financials, the stock's not going to necessarily run away from you. And so you're going to have levels here where you can buy this, in my opinion. Now, is this the bottom that we made down in here, right above $10 per share? Maybe, but we're really close to it. And so we're about $1 over it. I would anticipate this stock to be in this range down here. The other thing you need to expect is likely more dilution, more share count coming, with these early IPO companies. That's typically what happens. So I would expect this stock to trade in this range. If you want to buy it down in here, look, I would do plenty of research and look into it just from a financial perspective and a chart perspective. This is one I wouldn't touch. And, just lastly, it is a recently IPO stock. You see, this stock has just gone IPO. Typically I just like to watch these things for a long period of time before I start to jump in. We've got a $3.7 billion valuation on that. And again, I just showed you the financials. They're an absolute complete disaster. And so there's nothing necessarily from a operating standpoint here. Now, from a balance sheet perspective, you do have about $300 million worth of cash. You got $1.9 billion worth of assets. From a liability side here, they do have a little bit of debt, and they have this, look at this long-term debt down here. We've got $400 million worth of long-term debt. So they've got quite a bit of debt on the balance sheet. My guess is the way this company is going to fund its losses, either more debt or probably more importantly, issuing more shares out into the public. And so that's something that you want to keep in mind, that they have a massive amount of debt. And in order to finance these losses, they're either going to need to take on more debt or they're going to issue more shares to kind of finance that. So again, not something I'd be super wanting to jump in on. I would tiptoe into a stock like this if you wanted to get into that one. Finally, last question says, I love your videos. They are so informative. For your next Q&A or even a separate video, I'd love to see you do a fundamental analysis of a stock, talk about their future potential, mode, CEO, intrinsic value, and so on. Hope you see this. Okay, so Lala Smith, thank you for the question. Talked about this a little bit last time on the Q&A. I'll tell you what, I'm going to do a longer video on this. I'm going to do more generalized videos. When we get into December and into next year, I'll do some more. It's called evergreen content, where we talk about things like this, that it's good the answer is good today and likely next year and into the future. Whereas a lot of what we talk about on the channel as we dive into the most recent numbers, and we're talking about stuff that really only has a month or two kind of time frame on it. Well, something like this, I talked about it a little bit on the last show. The first thing I want to look for in a company or a stock in particular in this example is I want that stock to be capable of winning a gold medal. Or we just had Masters today. I want to pick the golfer capable of winning the Masters. Okay. When you came in this week and you could go to the Masters, or you were going to sports bet on the Masters, well, there would be about 4 or 5 golfers that are almost someone that you definitely want to bet on. Same thing with the Olympics. When it comes to the Olympics, there's 4 or 5 athletes or teams there that are almost guaranteed to win the gold medal. Okay. So I love to bet like men's basketball and United States men's basketball, United States gymnastic teams, United States men's swimming team, and the women's swimming team as well. So those types of things I like to vest in with the stock market. So like an Amazon, obviously going to win a gold medal in e-commerce, win a gold medal in cloud computing, probably win gold medals in some other stuff too. And along the way, Amazon's going to pick up some silver medals too. They'll pick up a silver medal in online advertising. They'll pick up a silver medal probably in logistics, like delivery and things like that. Will they be as big as FedEx and UPS one day? Maybe. But if not, they'll win a silver medal behind those two. And look, that's a big business as well. Same thing with maybe like a company like Apple. They win the gold medal with cell phones. So along the way, they win a gold medal with software. They win a gold medal when it comes to App Store. They win a gold medal when it comes to computers and things like that. And then they probably pick up some silver medals along the way, maybe something they're doing with their Apple TV and things like that. So that's what I like to look for, is companies like a Nike, Amazon, Nvidia, Apple. I'm just naming off the stocks that I'm an investor in, and I'm not trying to pump up my book or pump up my portfolio. It's just, again, a strategy that I've had for many, many years now, almost a decade, and I just continue to build on it as the future grows and the strategy tends to work. So when we talk about the future potential, again, we're talking about gold medals. We're talking about companies that are just going to be able to dominate. When we're talking about CEOs, I don't necessarily mind CEO changes. When you look at like a Nike, it started with a Phil Knight, then I think it went to Mark Parker, and then we're on to, I don't know the new guy's name, but when you get to a status of Nike, now we're starting to talk not only about the market, but we're talking about brand as well. So Nike, Apple, Amazon, they have absolutely phenomenal brands. And so in my opinion, the CEO matters slightly less in that sense, because you look at Apple, started with Steve Jobs. They went to somebody else. They went back to Jobs. Now we're on Tim Cook. Well, the stock has performed very well under Tim Cook, and it obviously performed well under Steve Jobs as well. So the CEO, while it matters, in my opinion, when the companies get more and more mature, obviously you're going to have CEO changes. Eventually you have a CEO change at Amazon, at Facebook, and some of these other companies that are still kind of founder-led, leading the company still. And so intrinsic value, not something I typically look at. Okay. I know they taught me this. I probably had to do numerous tests on this in college, but intrinsic value is not necessarily I look at. If it's something you guys want to look at, if something you want to evaluate, by all means, put it in your toolbox and use it. I don't typically use that. Moat is another thing. I think it's subjective. You look at a company like Nike, look, anybody can make a t-shirt and put a logo on it, okay? Nike doesn't necessarily have a moat around its business. The moat around Nike's business are, in my opinion, probably its sponsored athletes. You look at like Michael Jordan. You can't replicate Michael Jordan. You can't replicate Tiger Woods. You can't replicate any of the athletes, the great athletes that Nike has had and has under their banner and wearing their logos. It's very difficult to replicate that, especially when we're talking about the greatest athletes of a generation, like a Michael Jordan, like a Tiger Woods. Okay, unless another company like Adidas or any of these other companies come in there and get the next guy, which is very hard because, as we've seen, athletes like Jordan and Tiger and those types of athletes come along very, very few times in someone's lifetime. And so, in my opinion, Nike's, just to give you a Nike's example, the moat is not necessarily the business itself, but like a peripheral of the business, which happens to be the endorsement. So just really quickly, that's how I look at things just from a broader view. I promise I'll do a video. What I'm going to do a video on here in the next couple weeks, probably towards the end of the year, is I'm going to do a video saying, here's my strategy, because I've had really good performance in the stock market this year and really over the last 3, 4, 5 years, implementing a very specific strategy. And so I'm going to post a video here soon where I walk you through that entire strategy. I'll show you all the stocks that I've invested in, show you exactly what I bought them for, how much they're worth today. And I think that'll give you a really good idea on my mindset and my analysis and the way I execute on this type of analysis and acquiring stocks for the long term in my portfolio. So hopefully that helps you out there. Thanks again for tuning in. Again, leave me a question down below. I'd love to hear from you and love to answer it on the next show. That about wraps it up for this one. We'll see you guys again this week. Good luck with your investments.